Welcome back to the Financial Literacy Project, presented jointly by the American Bar Association's Tort Trial and Insurance Practice section, along with Thomson Reuters. This is the third segment of the Understanding and Managing Debt module. In the prior video, we discussed some common sources of debt. In this segment, we will cover credit and FICO scores and discuss their importance and how they are determined. Please read our legal disclaimer in full. In sum, these materials and any forms we reference are intended for educational and informational purposes only. A credit score is a number that represents a rating of how likely you are to repay a loan and to make those repayments on time. Lenders calculate your credit score using information in your credit report, such as your history of repaying money that you previously borrowed, the types of loans you've had, how long you've had a particular line of credit or loan, and how much total debt you owe. Credit scoring systems calculate your credit score in different ways, but the scoring systems most commonly used by lenders and other creditors is the FICO score. Why are credit scores important? Lenders and other creditors use your credit score to figure out whether you would be a good risk for the types of debt you just learned about. Companies use credit scores along with other factors to decide whether to sell you a policy or a service. Credit scores can affect the terms of the credit you're offered. Having a higher credit score means businesses see you as less of a financial risk, which means you're more likely to get credit or to pay less for it. That includes the interest rate you'll pay to borrow money. How are credit scores determined? A consumer's credit score typically will fall between 300 and 850. A high score means you have good credit, which means businesses think you're less of a financial risk. You're more likely to get credit, either a loan, a credit card, or an insurance coverage, or to pay less for that credit. A low score, on the other hand, means you have bad credit, which means it will be harder for you to obtain a loan or obtain it on favorable terms. How is credit monitored and reported? Credit scoring systems are complicated, and they vary among different businesses. Some systems may consider additional factors or may weigh factors differently. Some creditors, such as landlords, will report your payments for a fee. But most ways of calculating your credit score consider the following types of information that are contained in your credit report. Have you paid your bills on time? If your credit report shows that you've paid bills late, or you've had an account put into collections, or you've had declared bankruptcy, that's likely to affect your score negatively. What is your available versus used credit? Many scoring systems look at the amount of outstanding debt you have compared to your credit limit. If the amount you owe is close to your credit limit, it's likely to hurt your score. How long have you had credit? Generally, scoring systems consider your credit track record. A short credit history may hurt your score, but paying bills on time and having low balances can offset that. Have you applied for credit lately? Many scoring systems look at inquiries on your credit report to see whether you've applied for credit recently. If you've applied for too many new accounts recently, it could hurt your score. Not every inquiry is counted. For example, inquiries by creditors who are monitoring your account or who are making you pre-screened credit offers are not counted against you. How many credit accounts do you have, and what kind of accounts are they? Although it's generally considered a plus to have established credit accounts, too many credit card accounts will hurt you. Also, many scoring systems consider the type of credit accounts that you have. For example, under some scoring systems, loans to consolidate your debt, but not loans for buying a house or a car, might hurt your credit score. Credit scoring models compare all of this information to the credit behavior of people with similar profiles to you, and then assign you a score. These scoring models may also use information beyond your credit report. When you're applying for a mortgage loan, for example, other factors may be used to determine your credit score, including the amount of down payment you made, your total debt, your income, among other factors. There are three primary consumer credit agencies: Experian, TransUnion, and Equifax. These agencies are important as they collect and store information about you that they use to generate your credit report. These credit reports are then used as the basis for your credit score. The following video will advise you on how to obtain a credit report. Accessing your credit score. As a result of the pandemic, and up until December 2023, everyone in the United States can get a free credit report every week from all three national credit agencies: Equifax, Experian, and TransUnion. This can be accomplished by going to the website annualcreditreport.com. That's annualcreditreport.com. What is a good credit score? A credit score less than 580 is considered poor. These scores are below the average score of U.S. consumers and demonstrate to lenders that you are a risky borrower. Credit scores between 580 and 669 are considered fair. While fair scores are below the average score of U.S. consumers, many lenders will approve loans with these scores. Credit scores between 670 and 739 are considered good. These scores are average or slightly above average of U.S. consumers. Credit scores between 740 and 799 are considered very good. These scores are above average and suggest to lenders that you are a very dependable borrower. Finally, a credit score of 800 or higher is considered exceptional. These scores demonstrate to lenders that you are an exceptional borrower. Under federal law, a creditor scoring system may not use certain characteristics. For example, race, sex, marital status, national origin, or religion. These are prohibited factors when figuring out whether to extend you credit. The law does permit creditors to consider a consumer's age, but any credit scoring system that considers age must give equal treatment to applicants who are older. You have the right to know whether your credit application was accepted or rejected within 30 days of filing a completed application. You also have the right to know why a creditor has rejected your credit application. The creditor is required by law to provide you with a notice that tells you the specific reasons for the rejection, or that you're entitled to learn the reasons if you ask the creditor within 60 days. The reasons the creditor gives you for having rejected your credit application must be clear and not vague or indefinite. Acceptable reasons could be, for example, that your income was too low, that you have not been employed long enough, that you have too much debt relative to income, or that you have a history of late payments. You also have the right to learn the specific reasons the lender offered you less favorable terms than you applied for, but only if you reject the terms. For example, if the lender offers you a smaller loan or a loan at a higher interest rate and you don't accept the offer, you have the right to know why those terms were offered. Finally, a creditor who denies you credit must also provide you the name, address, and phone number of the credit reporting agency that supplied the information for your credit application. If denied, you should contact the credit reporting agency to find out what your credit report said. This information is free if you request it within 60 days of being denied credit. All right, that concludes this segment. We hope you now have a general understanding of credit and FICO scores, including why credit scores are important and how credit scores are determined. In the next segment, we will cover debt collection and your rights during the debt collection process.